Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. We'll be taking a look at three reasons why the rally in Intel will likely slow here post earnings. And as we always like to do, the best trade, right? Not much to give advice without giving a way to take advantage of it, right? To take advantage of the still high IV, even post earnings in Intel. As we always like to do, as you probably know by now, take that fusion approach, looking at fundamental, technical, and as always, implied volatility analysis. So let's jump in and take a look, shall we? First of all, from the kind of fundamental standpoint, Intel did report earnings Thursday after the close. You can see the stock surged to a record high, and this is an all-time high, beating the 2000 highs in Intel, right, on Friday as earnings came out and were certainly very nice earnings, beating by a decent amount on both the top and bottom line, also guided higher. But interesting to note, shares of Intel rose about 25% on the day, even though they did pull back off the highs, which we'll take a look at in a second. And the first record high since August 31st of 2000, the height of the NASDAQ mania. Earnings were good, 29 cents, well ahead of 2 cents, right? And up from 13 cents last year. So earnings, certainly if you look this year to last, better, but the stock has ripped incredibly higher since then. Revenue for the quarter reached 13.6 billion, right, ahead of the roughly 12.4 billion and up 7% on the year. Guidance, they expect sales or revenues, right, to grow 11%, yet the shares were up 24% based on kind of that guidance. So that means that the valuation multiples expanded. I pulled off the price to sales because the price to earnings, Intel had been actually losing money, negative earnings up until just recently. So on a price to sales basis, here's the year to date chart. You can see that explosion higher, right? And this factors in that nice kind of revenue, right, of 13.6 billion. But you can see just at the highest level we have seen this year, and also by far the highest level we have seen in the past decade. So Intel valuations certainly getting to an extreme. I did a kind of a little forward earnings estimate, right, using 2027 earnings expectations and using the highest earnings forecast of $1.36 per share, right, for 2027. Took it compared to the stock price of roughly 85 bucks, right? So certainly you can use, even 80 if you want, somewhere around there, but just use 85 bucks, which is kind of the mid-ish point on our trade we'll be looking at, right? So if you take $1.36 times the stock at 85, the forward PE, right, is well over 60 times, right? If you go with a lower stock price, right, that forward PE obviously will be even higher here. So you can see that, it is a very, very rich forward PE of well over 60, right, for Intel. What sort of earnings explosion they have to justify this remains to be seen. And we'll take a look in a second from a technical basis just how kind of overdone it has been. So certainly Intel getting to valuation fundamentals levels that maybe are getting a little stretched, to say the least. On the technical perspective, here I pulled off the 1-year chart on Intel. You can see getting overbought. This is 85 on the 9-day RSI basis. Basically has not hit that over the past year without having a pullback of some sorts, right? Has been close to there, or actually up there briefly a couple times, and instantly did lead to a pullback or at least a flattening out in the share price, right? So the fact that the stock gapped higher, as you can see here, moving from basically 65 to kind of that 85-ish level, right, before dropping a little bit, certainly a gap that might, pull back and fill that gap at somewhere along the way. You can see shares now trading at the biggest premium to the 20-day moving average by far over the past year. You can see the MACD starting to rip higher after it was ripping higher here, right? It was starting to level off as the stock consolidated in front of earnings. Then that huge gap, right, put MACD taking away this sort of pump up. MACD now at basically the highest level of the year. Again, Bollinger percent B, and that's with IV dropping just slightly, right? Also over 100. So all the technicals certainly pointing towards a pullback. Also, that doji that we saw on Friday, right, where shares basically traded up to a fresh new all-time high of just over 85, but closed well off that high, might be a sign of that indecision, right, where the buyers are starting to run out of a little bit of steam. We shall see on that, but certainly shares getting a little bit overdone technically. And as we said, earnings were good, but maybe 25% pop good on Intel, but we saw the semis all rip in unison. So we'll see what happens. Also note here, we'll take a look in a second. IV, we didn't see the usual post-earnings vol crush on IV, which will set up nicely for the trade we'll be looking at. So speaking of IV, let's jump over and take a look at IV. So I basically simply pulled off the implied volatility on the 60-day, options. Here you can see it is. Here it is having that usual run up into earnings, and then usually you get the vol crush like back here post earnings. This we had a slight, and I do mean slight flattening out. Actually, on the long end, IV increased because we saw just huge run-ups in some of the other chip-related stocks, AMD and the like. We saw NVIDIA rip higher as well. So all the chip makers kind of trading up in unison with Intel. You can see a slight pullback, right, from Thursday to Friday, Thursday in red, Friday in green here on the kind of 55-day, which is that trade we'll be looking at IV. But IV still certainly elevated at the highest level pretty much of the past 12 months. Here we can take a look at a little bit shorter term time frame, going back to when Intel was on the lows, right? On that big sell-off that we saw back here, right? So we're taking a look at IV going back there. We saw the IV hanging around that kind of upper to mid 65 level, now trading towards 72. Even post earnings, we only lost a little bit, and the June options, the ones that we're going to be looking at, basically remained flat even post earnings from an IV perspective. So IV certainly still very elevated post earnings and with the stock at all-time highs. So which is unusual unto itself. Usually a move higher in stocks tends to have IV drop, but we saw massive call buying in Intel and other chip-related stocks as well. Here's kind of a look at that 60-day 30 delta call. Here's the last earnings, right, which was the only other time over the past 6 months that IV was basically higher than it is now. We saw that usual vol crush. Once earnings were reported, the unknown became known. You saw IV just dip in a huge way, right? Here, not much, saw a little minor pullback, right? A flesh wound, let's call it. So IV still hanging out at by far the highest level we have seen over the past 6 months. So this favors doing option selling strategies. So the trade I kind of like the best is an iron condor trade going out to June, right? Giving plenty of cushion. So selling the 100-105 call spread to the upside. Intel closed at 82.54 as we saw earlier, right? So plenty of cushion there. And then the put spread, 65.60 put spread, getting about $1.75 or so on the trade, right? So getting a very nice overall premium, trading at well over a 70 IV. And as we said, that is by far, as we looked at earlier, the highest IV we have seen basically all year, except for that brief moment, basically one day before the last earnings report, which then faded quickly. This one hasn't faded at all, so this is a great time to jump in and take advantage of what should be a vol at least pullback, if not the vol crush post earnings, right? We haven't seen any of that, so you can capture some very nice vol. You can also kind of take advantage of the fact the stock looks to be running out, maybe of a little bit of steam to the upside. The most overbought it has been over the past, 12 months by far. As we said, valuation multiples, when we took a look at that, by far the richest valuations. So the upside looking to perhaps be capped, but as we know, no stocks go down in this market exceeds. So I kind of chose that 65, which was kind of where the stock was consolidating before. So I look for this level because earnings were absolutely good to kind of hold here, and then to the upside 100. And the fact that we're seeing IV still at pretty much the highest levels over the past 12 months means we can get out of the money further, right? Have a bigger cushion and get a very nice credit. So that sets up ideally, I think, for that iron Condor trade, right? Selling an out of the money call spread and put spread both, bringing in about $1.75 or so. So here is the trade, bringing in $1.75 on that trade, risking, excuse me, only 325 5-point wide spread. We're getting $1.75, so we got 325 total at risk if we get a blowout above 105 or below 60. So our potential return on the trade is well over 50%. We got 52 days to go right out till traditional June expiration. Selling, as we said, an IV well over 70. And taking a look at the short strike prices, right? The $100 call, right, which is part of our 100-105 call spread to the upside, you have over 20% upside cushion, right? 21.15%, right? And to the downside, the 65 put, right? Pretty much equidistant, right? As close as you can get almost, right? So you have more than 20% cushion, less than 2 months to go, right? On a stock that's already reported earnings that is looking at least a little bit overdone to the upside, right? And using the old kind of launch pad lows right around that 65 level, as we said, to kind of position to be, if you will, a buyer back down here after a nice, very nice earnings report, no question, but with everything else kind of getting stretched, having no problem perhaps looking to be a seller way up here, have plenty of cushion, take advantage of that high IV on an overvalued, overbought with overly rich options Intel. So we'll see if it works out. As we always like to say, trading is all about probability, not certainty. So make sure you position size accordingly, right? And make sure that you get out of the trade when it gets to a point that you're not happy with. Here, because we have defined risk, right? Even a huge rip or a huge dip, right, won't hurt us too bad. And we have plenty of time if we have to hedge, right, by selling, say, if, for example, the stock rips higher, we can sell some out of the money put spreads, shorter term basis before June, bring in some more money to further hedge or chop wood, as I like to call it. So until next time, as always, here's to good trading. Take care.